Hi, my name is Matt Storms, and today I'm going to talk about the different types of transaction structures in connection with the sale of a company. There are a variety of reasons for structuring a transaction a certain way, which I'll cover in a separate video. Today I'm going to talk about the overview of the main types of transaction structures. The first type of transaction structure that I'd like to talk about is an asset sale. Typically in an asset sale transaction, the seller sells all or substantially all the assets to the buyer. Usually only specific liabilities of the sellers are assumed by the buyer. From a tax standpoint, in a taxable sale of assets, the seller recognizes gain or loss from the sale of assets, and the buyer obtains a basis in the assets according to the purchase price allocation, which usually entails a stepped-up basis in the assets. If the seller is structured as a pass-through entity, such as an S-corp or a limited liability company taxed as a partnership, the gains or losses flow through the individual owners of the seller as a single layer of taxation. On the other hand, if the seller is a C corporation, which most of our clients are, gain is recognized at the corporate level, and any distribution of the proceeds are taxed as either dividends or as liquidating distributions. This yields a double layer of taxation, one at the corporate level and one at the shareholder level. This makes asset sales more expensive from a tax perspective for a C corporation. The next type of transaction I'd like to talk about is a stock sale. Typically, the stockholders of the corporation to be sold transfer their stock in exchange for cash, securities, or other consideration. As the selling corporation is left intact, all the assets within the company being sold, as well as the liabilities, are kept with the entity that is sold. It's just that the control of the corporation changes. From a tax standpoint, in a taxable stock sale, the sellers typically have capital gain or loss upon the sale of their stock. The buyer's basis in the stock is usually the purchase price for the stock, as well as the transaction costs associated with acquiring the stock. The basis in the assets of the company being sold remain the same for the buyer, unless the buyer makes what is referred to as a 338 election with the IRS. A 338 election basically treats the transaction as an asset sale for tax purposes, which, if made, presumably would allow the buyer to have a stepped-up basis in the acquired assets, even though the transaction was structured as a stock transaction. One thing to keep in mind, though, is that there typically is only a single layer of taxation for a stock sale, and it is at the capital gains rate. The third type of transaction is a merger. In a merger transaction, the seller typically merges into the buyer or a subsidiary of the buyer, or a subsidiary of the buyer merges into the seller. In any case, the surviving entity of the merger is the buyer or the subsidiary of the buyer. I know that's a mouthful, so let's go through some examples. So in this first example, which I refer to as a direct merger, is the seller merges into the buyer. The next one is a forward triangular merger. In this situation, we have the buyer creating a wholly owned subsidiary, and then the seller over here actually merges into that subsidiary. So after that transaction, the buyer owns the seller as a wholly owned subsidiary. Next is the reverse triangular merger. As with the forward triangular merger, the first step is the buyer creating a wholly owned subsidiary. But in this case, the subsidiary is the one that merges into the seller. The only difference between these two structures is whether the subsidiary merges into the seller or whether the seller merges into the subsidiary. From a tax standpoint, in a taxable merger transaction, the tax consequences will vary depending on how the merger transaction is structured. For direct merger and forward triangular merger taxable transactions, they are both generally treated as taxable sale of assets, followed by a liquidation of the selling company. For a reverse triangular merger, that last one, the taxation is usually treated in the same way as the sale of stock by the selling corporation stockholders. So far, I've been talking about taxable transactions. There are, however, ways in which to structure transactions in each of these transaction types to be free from U.S. federal taxation. Regardless of the structure, they are generally referred to as tax-free reorganizations, and the requirements to make them tax-free are significant and complex. For example, the consideration paid in the transaction must be all, or in some cases at least a substantial portion of the buyer's equity securities. In addition, there must be a continuity of proprietary interests and a continuity of business enterprise before and after the transaction. Among other requirements, there also has to be a business purpose. When attempting to make a transaction tax-free, considerable time and effort is often spent ensuring that the requirements are met. So what are the takeaways of the different types of transaction structures in connection with the sale of a company? One, there are many ways to structure a transaction involving a sale of a company. Two, the three most common types of transaction structures for a sale of a company are an asset sale, a stock sale, and a merger. Three, the three most common merger transaction structures are a direct merger, a forward triangular merger, and a reverse triangular merger. And four, while transactions can be structured as tax-free, there are many requirements associated with making them so. I hope you found this overview to be helpful. If you have any comments, let us know. Thanks.